Hey everyone, it's Rich Warner from WealthMaxBuilder.com. It's a lovely spring Sunday morning here in the Northeast, and I'd like to share with you an update on performances of some of the WealthMax Builder models so far this year, this being after the first quarter of 2019. I'd like to say at the outset that I've been tracking the performances of some of these models in separate simulated trading accounts at interactive brokers. Now, it's important to understand why I do this. Why do I track the performances of these models in simulated trading accounts at IB? Well, first and foremost, there is a law that says that if you sell trading signals to the public, you really can't be running them in real, actual trading accounts without running into conflicts of interest. So there's a legal stipulation that says you cannot do that, because what ends up happening in some instances is if you were to, let's say, generate a trading signal and then you apply that to your own personal trading account, and after that you then distribute your signal, well, then you're guilty of front running the account, which means that you're using your clientele to basically support your trading decisions, and that's illegal. So to avoid any conflict of interest, what I do is I make sure to run each and every WealthMax Builder model in its own separate interactive broker simulated trading account. At interactive brokers, you can set up your own paper trading accounts after you set up real trading accounts, that is, and you're given 5 paper trading accounts, each with a starting capital of $1 million. And so that's what I've done. I started out with $1 million in each of these interactive brokers trading accounts. And the cool thing about these interactive simulated trading accounts is that when you do the trades, you actually go through the same trading execution process as you would if you're trading a real trading account. And these transactions factor in slippage and commissions. So this is about as close to the real thing as you can ever get with a simulated trading account. This is not the case at many other paper trading accounts at brokerage firms. What I really love about these simulated trading accounts is that it enables me to be as faithful and truthful to each and every model as I can be, factoring in the slippage and commission. Because when I do the trades for these simulated accounts, what I am doing is I'm using market orders. And this is much better than if you're using limit orders for various reasons. I won't go into the efficiency of market orders over limit orders right in this particular video. But the point is that when you're trying to replicate a real trading account, you need to factor in the true bid-ask spread. And when you use market orders only, you are at all times forced to buy at the ask, and you're forced to sell at the bid in all transactions. And so that makes it that much more accurate and realistic. And the commission costs and the fees are typical of an account of that particular size. And the other reason why I like simulated trading accounts to track my trading models available on WealthMax Builder is that when you have real trading accounts, and I'm sure many of you who are model developers or you're trying out a new particular strategy have encountered this many times, and there's a difference between what your trading models are telling you at any given point in time and what you're actually doing. It's very tempting to override your models. So for example, if you've had a string of let's say profitable trades in a particular trading model or strategy, you may be reluctant to take the next trade, for example, because you're kind of thinking, oh, well, I've had such a streak of winners here, I'm bound to have a losing trade. And sometimes you'll forego taking that trade, or there may be an instance when, for example, you're sitting on a huge profit and it's like enormous in terms of percentage return on investment, and you're thinking, wow, I better take my profits now, and so you preemptively close out the position instead of sitting on the position longer or as long as the model is telling you to do so. So the point is that there's a lot of overriding between what is actually done in trading accounts and being truthful to taking and being faithful to each and every signal that's generated by that model. So to avoid the conflict of interest and to be truthful to each model in its pure sense and taking each and every trade and only trading when the signals are generated. I love tracking my models in the simulated trading accounts at Interactive Brokers. And so then what I do is I generate PDFs from the Interactive website, and these are reports that can be translated into Excel spreadsheets, which I happen to import, and then I put them into my own spreadsheets, and then I do the calculations based on risk and reward gauges, and also create the performance graphs. So if we take a look at the WealthMaxBuilder models, which by the way are all discussed under the products, if you click on products, that'll take you to another page here. It shows some of the publications that I've written, the Essentials of Investing ebook, for example, which is an excellent book. You really owe it to yourself to getting a copy of this. It's available on Amazon in the Kindle book section. Essentials of Investing by Rich Warner. That's me, and it's available now at a one-time discount price of $19.95, which is like an incredible deal. Anyways, if you scroll down, there's the video course, and you can purchase this directly off of the website. Here's the Ultimate Global Stock Allocator weekly report. I also do fund and asset allocation reviews and consultations. Now, I do this as kind of like a generic service. I'm not trying to be your financial advisor per se or investment advisor. I am simply trying to determine whether your existing portfolio or portfolio of stocks and asset allocation happens to make sense from a reward to risk basis. So I'm checking your correlations. I'm seeing if you're overweight certain sectors of the stock market, if you're overweight stocks relative to bond funds and things like that. So that's basically what that's about. It's not a personal one-on-one type of consultation necessarily. So I try to do this as generically and realistically on a reward to risk basis based on historical data alone, not necessarily particular to your particular time horizon or personal needs. I have to be clear about that. I am a principal of a certified registered investment advisory firm and in a particular state in the Northeast, and I do not want to encounter any situations where I step outside the law. So I have to be very mindful of giving personal asset allocation advice to clients unless they're inside the state of Connecticut and they happen to be one of my clients. So basically, I am limited to giving you a general overview of your asset allocation. So I'm not able to give you personal financial advice necessarily, but I can discuss your overall asset allocation mix and say that based on historical data and correlations, your particular weightings may not be ideal, or this particular fund should be replaced by a more efficient fund based on management fees and also based on performance. So that I can do for you. If you have a particular fund that you're looking at, a mutual fund, or a set of stocks that you're unsure of, I'll take a look at them for you to determine whether you're over-concentrated in a particular sector or asset class, and I'll do that sort of review for you. Stepping down here, you'll see the performance results of all the WealthMaxBuilder funds that I have available. I juxtapose them against the total U.S. stock index here, VTI in pink, and the Barclays Aggregate Bond Index here in dark blue. And this is based on weekly data starting in October 12th of 2018. This should be 2018, not 2019, excuse me. I'll have to correct that. As you can see from the chart here, it's a lot clearer to see here. The red line is the U.S. stock index. Okay, that's VTI, the total U.S. Stock market index from Vanguard, ticker symbol VTI. As you can see, we started off in October going sideways pretty much, and then in December there was that dip with all the controversy with the president and whether or not he's going to be indicted. There was the Mueller report and the investigations and all of this, and there's also the trade tensions with China, and the U.S. market dragged essentially all the global equity market indices down as well. But as far as the U.S. is concerned, you have this dip here in December and then a rebound that's carried on up until into the first quarter of 2019. So we're ending up positive here, 5% return. And my particular directional signal for the U.S. is slightly behind VTI. But as you notice, the yellow line is the WealthMaxBuilder U.S. stock market model, and it has a much higher profit factor than the U.S. stock market does. And profit factor factors in basically how many positive returns you've generated divided by how many negative returns you've generated. And reward to risk is the ratio between your average annualized total returns divided by the standard deviation assumed to generate those returns. So it's reward to risk as well. So these are two very important gauges of the performances of models. So I like to look at both of them, but if I had to choose one over the other, it would probably be profit factor. But they basically say the same thing in terms of whether, which models are better for every ounce of risk that you need to assume in order to generate returns. So we obviously want to get a hold of the models that generate the highest reward for every ounce of risk that you take. So we're looking in both cases. We want the highest reward to risk ratios, and we're also looking for the highest profit factors in each case. And what you'll notice if you're a model designer after years of doing this, you could basically distill this into a visual. And what you're looking for is essentially the equity curves that are the most positively sloped. Okay, we want to be making some money here. We obviously don't want to avoid these dips, and models that are not profitable, they will be negative. So we want positively sloped equity curves or cumulative return lines with the least jaggedness. So even if you have a model that has a very steep return, there may have been a significant amount of gyration or volatility assumed to get that return. So it's not necessarily the ones that have the highest ending points relative to starting points. That may not be the ideal model for you, and certainly not for me. I'm always looking for generating models, as all of us are, essentially with the highest positive slope, but with the least amount of jaggedness that we had to assume to get those returns. So as you can see here, the line that stands out to me with the most, with the highest profit factor and reward to risk ratio is the black line here, and that's the WealthMaxBuilder passive portfolio. This happens to have been a very strong first quarter for both stocks and bonds. We've been sort of doubly blessed here, and this doesn't always happen in history. It's often the case that stocks will outperform bonds and bonds will do terribly, or vice versa. There's usually some sort of yin and yang effect between stock funds and bond funds over periods of time, and it's rare that you have a series of weeks or months such as we've had over the past three months or so, where both the stock market and the bond market are doing phenomenally well, or shall I say, very well. So because both stocks and bonds have done pretty darn well here at the start of the first quarter in 2019, passive allocations like the WealthMaxBuilder portfolio have done very well, and that's the black line right here. But over time, what's going to happen is I'm sure they're going to be circumstances when, we're going to get a pullback in the stock market, and it could be a bear market, or there could be a bear market in bonds. And in that type of scenario, the passive allocation will hold up, but it may not do as well as, for example, a long-short equity model such as the VTI Equity Long-Short WealthMaxBuilder or Core Satellite, which happens to go long and short stocks with a perma core allocation to bonds. I think the important takeaway from this particular lesson is how well a passive allocation can do relative to timing models. I've got data going back on passive allocations going back to 1925. And you really need a lot of months and years of data to get the whole perspective. And what I'm saying, based on my experience, is that the timing models do hold their ground over time. It is highly likely that with a passive allocation, no matter how good it is, and this one happens to be an excellent allocation, and I've done a lot of years of research trying to optimize asset allocation across stock funds and bond funds and even some commodities. But no matter how good your passive allocation is, there are going to be years when you're going to give back money to the market. It's just part of the deal. You have to accept that. The better passive allocations will, however, pull themselves back and continue to make profits after giving back some money to the market in a certain year. And how often does this occur? In my experience, it's about every 7 years, every 6 to 7 years, you'll experience a negative down year for a solid competitive passive allocation. And if you're interested in subscribing to get the signals or for the allocation for the WealthMaxBuilder passive allocation, I call it the Emerald 2.0, that's on this website here. If you scroll down, again, you just have to click on products and scroll down to where it says WMB Passive Asset Allocation, buy now. And then when you click on this button, you will get access to the spreadsheet, which shows you exactly which funds I'm using for this WMB passive allocation. I would like to say that parenthetically, the WMB passive 2.0 Emerald allocation, which is the one I'm tracking here, is very similar, but it's not identical to the Ray Dalio allocation that you'll find in the Tony Robbins book, Money Master the Game. Now, this book by Tony Robbins called Money Master the Game, 7 Simple Steps to Financial Freedom. It's a pretty good book for personal finance matters, but the reason I bought it is because in the middle of this book, somewhere deep into the middle, second half of the book, there's this discussion of Ray Dalio's all seasons portfolio. This particular asset allocation, parenthetically, happens to be very, very similar in spirit. I like to say that I'm kind of like a spiritual kin to Ray Dalio, in that my passive allocation is very similar to this one, but it's not exact. There are certain areas where I differ with the Dalio allocation, but the overall asset balance between stocks and bonds is where we kind of agree. I also track this particular recommended allocation in my spreadsheets and compare how the WMB passive allocation has done relative to it. And wouldn't you know that because the compositions of the portfolio are very similar, our performance results have also been quite similar. And I'm just going to say one more thing about the Ray Dalio all seasons portfolio, and it's this: I just don't agree with him that we should allocate 15% to commodities. I do not believe that a 15% allocation to commodity indices is a way to build wealth over very long periods of time. Historical data going back, not just 100 years, but like 200 years and so, show that commodities just don't generate any real returns over very long periods of time. Yes, there are upswings like we saw in the 90s, for example. We had that incredible run in commodities And then it sort of went bust in the early 2000s and so on. So the net result is that you're not really creating wealth with commodities, and so I cannot justify a 15% allocation to commodity indices or index funds. My WMB passive allocation does not allocate much, if anything, to commodities. There is some allocation to gold. I believe that gold has a special place if you're a U.S.-based investor, particularly because of the U.S. dollar. And gold does have an anti-correlative yin-yang effect to dollar investments. It sort of hedges you against a depreciation in the U.S. dollar. But that is pretty much the only reason why I favor an allocation to gold. In terms of the rest of the commodity sectors, I am nowhere near them. I don't believe that they should be in a long-term passive allocation. And that's pretty much the huge difference between the Ray Dalio All Seasons portfolio and the WMB passive allocation. Again, the interesting thing that you should keep in mind here is pay attention to the reward to risk ratios and the profit factors. If you take a look at them, they've been very high relative, especially to the U.S. stock market index. If you're a U.S. stock market investor and that's all you have your money in, you're really risking a lot of volatility, as you can see here. And these days especially, we really must be quite vigilant about over-allocating to stock indices because the valuations are simply out of hand, especially when it comes to the U.S. relative to the rest of the world. That's not to say that we have a bear market imminent in the coming days or weeks, but you should definitely under-allocate here to the stock market of the United States, particularly because of the valuations. We haven't seen these type of valuations since 2008 and also 2000. These valuations are extremely high. And the WMB passive allocation, as well as the Ray Dalio, will help you preserve capital better over the coming years. Another portfolio that may be of interest to you will be the Core Satellite, which is a perma allocation to bonds with a sort of a dimmer switch on stocks. So the portion of your allocation to stocks is actually has this on-off switch. Essentially, I'm employing the U.S. equity long-short signal here, and whenever it goes short, I'm turning off the switch to stocks in the Core Satellite program. There's a set allocation to the fixed income, and that's your core. That's kind of like the sun, and then the satellites are like the planets around the sun, and those are on or off depending on whether we're heading into a bear phase or whether we're in a bull phase of the market. So there's a simple on-off switch that you follow, and that's the Core Satellite Hybrid. This one does very well, as you can see, preserves capital during downward spills in the stock market. It so happened that the WMB passive portfolio has done very well throughout the bear spill that we experienced in December. So that's a very reassuring sign. Once again, if you're interested in subscribing to these signals, all you need to do is head on over to WealthMaxBuilder.com and click on Products, and then scroll down to where it says Subscription Models. And here's a little notification for subscribers I'd like you to read. It's kind of a disclaimer, and it also talks about how I use the simulated trading accounts for the performance data. But if you scroll down here, you'll see the links for buying the WMB Core Satellite, the U.S. Benchmark Equity Index Signal, long short, and finally we have the passive allocation WMB Passive, which is the 2.0 Emerald portfolio. This is the one that's similar to Ray Dalio's All Seasons portfolio. And finally, we have the WMB Ultimate Global Stock Allocator, which is kind of a summary of where I think you should be as a long-term investor in terms of your asset allocation, helping them decide how much they should be exposed to stocks relative to bonds. Now, there are three main drivers for this particular analysis, and the first is market valuations. As we can see here, currently stock market valuations in the United States are extremely overvalued. So therefore, we have to keep a lid on our allocations to equities relative to bonds especially. The market trend and momentum currently of the stock markets of the world are positive. So despite the fact that equities are overvalued in the United States, we still have a bull signal running into this euphoric period. So my suggestion would be, don't fight the trend. You fight the trend at your own risk. You have to be in it currently until the signal changes. We're still exposed, but we're under allocating based on valuations. Let's put it that way. In terms of fixed income implications, and as we can see currently, there's a mixed picture that I'm getting from the fixed income markets. You may have heard that recently there's been a lot of talk about the yield curve being inverted and that this is an ominous type of signal. And I don't know how they're reading that information, but it goes to show you that there's a difference between what journalists have to say and what you should be looking at. I can't see for the life of me what these people are looking at. I do not see how the way they're interpreting the yield curve at this point, how that can be so ominous. I think it's a misreading, frankly, and that you really have to study the implications of such matters before you rush to a conclusion. Take a moment to take a look at these suggested overall asset allocations, and this is based on time horizon information. I'm not allowed to give you specific personal recommendations, but in general, based on historical data, I think, and the behavior of bear markets and the recuperation time, basically the shorter time horizon that you have to retirement, or let's say you're in retirement currently, the less you should be exposed to equities. And the reason has to do with the recovery time for bear markets. The recovery time can take anywhere from 5 years to 10 years to 25 years in some cases. So on average, you're looking at a recovery time of, 10 to 13 to 15 years to recover from a bear market. And it's this 15-year recovery time window that is influencing how much you should be allocating to the stock market. So obviously, if you have more than 20 years to go to your retirement, you can afford to allocate much more to the stock market, assuming that you're not timing it or anything like that. You're basically on a passive asset allocation here. The closer you get to retirement, you want to scale it down. And when you're in retirement or less than 15 years to retirement, then you need to really downshift by 10% from the more youthful asset allocation, as we see here. So currently, these numbers, 35%, 30%, and 25% allocation to stock funds, is based on the current scenario. If the stock market were not overvalued here, this number could be as high as 45% for someone with more than 20 years to go. But since we're in this overvalued scenario, my model that I use to calculate this summary table here tells me that we should not be more than 35% allocated to stocks. This third section here is a summary where I usually provide subscribers with my favorite plays for the U.S., global stock indices, as well as fixed income, and which markets or sectors I don't like. If you want a hold of that information, you can contact me at richard@wealthmaxbuilder.com. And after you pay a subscription fee, I will give that information to you. As far as the key reports and events this week, last week we had on Friday the labor stats, which were not, super, and they were not bad, but they were kind of lukewarm. We had something like 130,000 jobs added, which is not stellar by any means, but it's not necessarily a sign of complete weakness. As far as the key reports and events to be mindful of this week, we have the CPI, the Consumer Price Index, this Wednesday bright and early. And then we have the PPI, which is the Producer Price Index. That's on Thursday. And if you subscribe to my WMB How Now Dow US Benchmark Equity Index long short signals, you'll be able to get the signal before the close of each day, whether or not there is a signal to change the direction of the market. It's currently long, it's currently bullish, and you know, I've learned through experience over the years that you're supposed to honor that signal as long as it lasts. Do not preemptively take profits or second guess it and shift out of stocks too early. You want to ride the bull trend as long as you get one, and this happens to be, you know, pretty long bull trend we've had since the bottom of December. But you know, you got to take these signals and ride them, and that's what separates the pros from the amateurs. If you're going to second guess your trading models, you're going to run into difficulty. And that's one of the reasons why I run these simulated trading accounts at Interactive Brokers. I want to be true to the model, pure and simple. I do not want to second guess the model. I take each and every signal and only the signals from these models when I make the transaction changes in these accounts. So that's it for this end of quarter review. I hope you enjoyed it, and if you have any questions or you want to sign up to my newsletter for updates to blog articles or YouTube videos like this one, I'm going to have another one shortly, sort of talking about some of the pitfalls you can run into and things to avoid and things to watch for, because there's a lot of information out there that may not be accurate or very useful, quite honestly. It's very important that you get a hold of the information, to get a hold of the track records of anyone who's giving you market timing signals particularly. Or even if you've got a passive allocation, you want to get performance data to prove that it can hold its own through thick and thin. And don't rely on reputation or sweetness of presentation on a screen or confidence in the way they talk necessarily. You know, it's really comes down to performance. So you have to check performance data and get a hold of real data. You know, there are many so-called stock market timers out there and stock picking gurus, and you know, they make a good living at it, but they must be cycling through their subscribers quite frequently, because a lot of the top ones that I check in terms of their testimonials of customer reviews on websites like investimonials.com, they don't really hold up. So do your research. I'm not in this review yet because I recently started my service. But as you can probably tell, I'm very data driven. I'm much more of a low-key type of person. I let my models speak for themselves. And the only way to really know what you're getting for your money is if you try it and run it for yourself, with the caveat that you are being true to the model signals. Because what you end up doing in practice with your own trading accounts may not be the same thing that the model is saying you should be doing. So keep that in mind. You have to factor in that you may not be taking each and every signal for your own personal accounts, which I do not encourage. You know, every quantitative model developer will tell you that even the best models will have some funk periods built into them. And they're just certain types of markets that you have to sit through and ride through, and you're not necessarily aware of when that funk period is going to end or start. The point being that you should be sticking with your model signals through thick and thin. And only then can you truly say that you are running the model. And again, that's why I run these simulated trading accounts at Interactive Brokers, because it's the closest thing to the real deal, factoring in slippage and commissions. Well, that wraps it up for this end of quarter review. I hope you enjoyed it. Please have a look at one of my services. I'd appreciate it. You can purchase, as I mentioned, the models or the books, the video course on investing off of the this website here, WealthMaxBuilder.com. Click on products, and that takes you to the Essentials of Investing ebook. Here are the models. And if you're interested, you can buy your trial subscription here. And if you want to drop me a line, click on this link, sign up for my emails and my and my blog updates and my YouTube videos. And in summary, I'd just like to say that the information you're getting is directly based off of the performance reports from the interactive websites, the PDF reports that factor in slippage and commissions. That's what these numbers are from. They're directly from the PDF reports, which are available for your own inspection if you'd like to check them out as well. So post slippage and commissions performances of each and every model, pure and simple. I'm not playing around here. This is the real deal. If you like what you see, give it a shot. Subscribe. I'm sure some big players would be interested in this as well. If you want to contact me for certain special arrangements, please do so. I'm at richard@wealthmaxbuilder.com. Thanks so much for watching and have a great day.